Okay, good morning, dear students. Apologies for delay by a few minutes because of heavy rain over here. So I was having issues with the network, so I switched to another network. Anyway, so
Very good morning, sir.
very good morning. So I think we have done with the equity valuation part. Okay, and now we have to proceed with the bond valuation part. Okay, so basically essentially the fixed income securities. Okay, so in equity valuation, we have covered all of the models, right? We have covered the cash flow model, dividend model, and every aspect has been taken into account. Now it's time for us to look into the bond markets. Okay, so let's go ahead with the bond markets or bond valuation, basically. Okay, for the time being, let us consider the bond and debentures. We're going to use them interchangeably. Okay. If I ask you about bond or if I ask you about, debentures, what do you really understand by that? What does that document signify? What do you understand by that?
So it signifies the fixed interest.
Fixed interest. Anything else you can think of?
Redemption also be there.
Bonds, are they signifying any sort of ownership?
No, sir. Ownership, no, sir. When there is a convertible into ordinary shares, then there will be ownership maybe there.
Okay, but ownership may be there, but then I'm just thinking of even if it's not convertible, do you assign any sort of ownership to a bondholder? Of course not, because remember, bond is something which we are signifying as a proof of debt. Right? It indicates indebtedness of the investor. Okay, it indicates indebtedness of the investor. Or indebtedness of the company towards the investor. Okay, it indicates indebtedness of the company towards the investor. Now, when we are talking of this bond valuation concept, we are essentially trying to value this debenture or value this debt. Okay, so there are certain basic terms that we need to understand before we go ahead with the bond valuation aspect. So the basic terms that we would need to learn or we need to be aware of. Let me just list down all of them. Then we will discuss face value. Then we have the maturity. Then we have a term called as coupon. Face value, maturity, coupon. Then something called as yield to maturity. Okay. And then redemption value. Okay. Now, what do we understand by the term face value? What do we understand by the term face value?
Sorry, it is a par value, sir, on the issue of the debentures.
It's called as the par value. What is the use of this par value, guys? What's the use of this par value?
To calculate the interest.
To calculate the interest, or I can say this par value is used to calculate coupons, to calculate the coupon amount, right? To calculate the coupon amount. So essentially, we can say whatever coupon you are going to get or the amount of interest you are going to get, right? This is the amount of interest, right? So this is interest amount, which is calculated as certain percentage of face value. Right? So it's used to calculate a certain percentage of the face value. That's the coupon. Right? So the only use of face value is to know that what is the amount of the coupon or the interest. Now, when we say face value or par value, we need to also understand this is sometimes, or in most of the cases, I can say, in most of the cases, it is also the redemption value. It is mostly also the redemption value. Unless and until the terms of the bond or debenture is something, we generally say that the face value is the redemption value. Now, what do you mean by the maturity? Maturity is denoting the time period for which bond will remain outstanding. Or I can say time period after which bond will be repaid or bond will be redeemed, you can say. There's a time period after which the bond is going to be redeemed. Okay. Now, so this is what we essentially talk about the maturity. The redemption value is what we can quickly make out from the name itself. It is the amount to be received on maturity. So at the time of maturity, whatever is the amount to be received, that is going to be the redemption value. Okay. By the way, this redemption value can be par, premium, or it can be also at a discount. Right. So if your par value of face value is 1,000, the redemption can be at 1,000. It can be at a premium of a certain number, and it can be also at a discount. Right. So redemption value is something which will be specified in the bond agreement. Okay. Now, coming to yield to maturity. What do we mean by yield to maturity? What do you mean by yield to maturity nowadays? Any idea? Yield to maturity? Have you ever heard of it?
Yeah, this is actually the required rate of return by the investor.
It's the required rate of
Return
by the investor. Good, true. So, yield to maturity is the rate of return required by investor. Okay. So if I tell you YTM is going to be a function of what all things? I mean, YTM is going to depend on, or yield to maturity is going to depend on what all things? What do you think?
depends on
coupon redemption value.
interest and the redemption value.
No, YTM will not depend on the interest. Coupon the company will give as per their requirement, as per their policy or as per their requirement. But then YTM will depend on what? The return which an investor require, it will depend on what?
It depends on the premium or discount and the redemption value. Based on that, it will vary.
It will depend on?
Maturity.
There is a when there is the risk of default.
Yes. The YTM primarily is going to depend on the risk of the bond.
The risk of the bond. Yeah, the risk of the
So risk of a bond,
default risk.
default risk, or there are other risks also. It will also depend on the maturity, right? Now, when I say risk, there are multiple risks that we are talking of when we are investing in a bond. What is it? What is the risk that we are talking of in a bond? What sort of risk are we looking at in the bond? You can define
Default risk. Yeah,
risk.
default risk is there.
Yes, risk of default, right? Also, you face multiple other risks, right? When you say multiple other risks, it means risk of change in the rate of interest that's ongoing in the market, like RBI increases or decreases the rate of interest. That's also going to have an impact on your bond value, right? Now,
Yeah, political risk.
there are multiple risks. Now, this risk of default is measured by something called as a credit rating, right? So, the risk of default that a company faces or a bond faces is measured by the credit rating of the company. Okay, so that is measured by the credit rating of the company. Okay, so now our idea initially is to understand how do they arrive at the value of the bond, right? That's first thing. Second thing that we are going to look at is how are we going to evaluate the risk of changes in the rate of interest by using the concept of modified duration, Macaulay duration, and convexity to some extent. Okay, so right now let's just go ahead with the valuation part. Okay, and apart from these two, like just from carrying out the valuation, understanding the interest rate risk of the bond, we'll also look at something called as bond immunization concept, and also the decisions of bond refunding, right? So bond refunding, when we say we're talking of quick or early redemption of the bond, whether it is beneficial for us to redeem the bonds before due date or it's not so beneficial. That's what we're going to look at. So right now, let me just go ahead with the concept of the valuation of the bond. Going by all the nomenclature, all the basic concepts that we follow, value of bond is going to be determined using the simple concept of finance. And anywhere we use a simple concept to obtain the value of the bond. How do we calculate value of any asset for that case? Yes.
Actually, like
Present value of
Mm-hmm.
yes, present value of that interest, that coupon, and as well as the present value of the redemption value,
Okay.
and upon that, yeah, that is the present value of that coupon plus the redemption value, present value of it.
Value of the coupon and the redemption value. So basically, value of the bond is nothing but present value of coupons plus present value of the redemption value. So value of the bond is going to be present value of the coupons plus present value of the redemption value, right? Okay, so when we're talking of this aspect, how do we, what should be the rate at which I should discount? This present value is going to be computed, but at what rate are we going to discount it? We are going to discount it discounted at yield to maturity. It's going to be discounted at yield to maturity. Okay, so that's going to be discounted at yield to maturity. Right now, so for example, let us say face value of a bond is 1,000. Coupon is, let's say, 10%. The redemption is, let's say, going to happen at 1050. Term or maturity is 5 years. And the YTM, yield to maturity of the bond. Okay. Yield to maturity of the bond is, let's say, 12%. Right. So with these aspects, can we calculate the value of the bond? So how do we go about calculating the value of this bond? How do we go about calculating the value of this bond? Can I say it's going to be 100, which is the coupon, into present value annuity factor at 12% for 5 years, plus 1050 into present value factor at 12% for 5 years. Can you help me with this number? There is. Can you help me with this number?
Yes, sir. Will
Yeah.
work out.
Yeah, just give me the value of this bond at a YTM of 12%.
$956.28.
Yes, sir.
956.28.
956.28.
25.
2825. Okay. So this is what we have the value of the bond at a YTM of 12%. Now, if I just change these aspects and I'm saying that with the same parameters, I'm just bringing a change to the YTM. So let's say instead of YTM being 12%, if I say that YTM is, let's say, 8%, then of course the present value factor will be calculated at 8%. Both annuity and present value factor will be calculated at 8%. Calculate the value of the bond, guys. Calculate the value of the bond. Just try to calculate the value of the bond.
Yes, so 1113.9.
1113.9.
Yes, sir.
Is it, everyone? Are you all getting this number? Yes.
So 1114.35.
1113.45.
35.
0.35. Is it, guys? 0.35 or 0.9? Take the PV factors up to...
Sir, I rounded off up to 4 decimals, sir.
Okay. So you're getting it as 9.
Yes.
Okay. Anyways, fine. So I just want you to look at, I'm just highlighting three numbers. Okay. Look at those three numbers and try to give me some sort of analysis or interpretation about that. First is the coupon, YTM, bond value. And over here also coupon, YTM, and the bond value. Any sort of analysis you can give from these numbers?
Yes, sir. When the YTM is decreasing, the bond value is increasing. The inverse relationship I could see, sir.
Okay, so we can observe YTM and the bond value. They are having a inverse relation, right?
Yes, sir.
Right. So you can say as the YTM increases, the bond value decreases, or vice versa, that YTM falls and the bond value increases. Okay, that is one interpretation. Second,
Coupon rate is constant. When the YTM is 12 percentage, that face value is look like 1,000 and the value is less. It's a discount. And also when that YTM is 8 percentage, coupon rate is 10 percentage. When it's decreasing, it's look like it's a premium, more than 1,000 rupees. But I'm not sure whether we can say that or not.
okay. So one thing which we can say is when the coupon rate, when we have the coupon rate, which is at a value which is lower than the YTM, or I can say when your YTM is more than the coupon rate, what we observe is that bond is trading at a discount, right? And when your coupon rate is higher than the YTM, then the bond is trading at a premium, right? So we can say general observation, bond trades at premium if, so bond is going to trade at a premium, guys, if YTM is less than coupon. And the second case is bond trades at discount if the YTM is greater than the coupon. Right? Can we have this observation, guys? Yes, we can definitely observe that. It depends on the relation. It's like, intuitively to understand it, we can also say coupon is the rate of return which the bond is giving us. YTM is the rate of return which I want. Now, if the coupon is 10% and I want 12%, right? If the coupon is 10% and I want 12%, will I be ready to pay the par value or will I be ready to pay discounted value? Of course, I want to pay the discounted value only. I want to pay the discounted value because I want to earn 12%. And if you are going to give me 10%, I will not be giving you the full 1,000 value for this. I will be obviously giving you a discounted value for that. And the other way around happens when your rate of return is like 8%, but the bond is ready to give you 10%. So you'll be ready to pay some amount of premium for that one. Okay. Are we able to understand it intuitively, guys?
Yes, sir.
Yeah. Okay. Okay, so that's the relation between YTM and the bond value. Now, a quick task for you guys. Let's discover something new about this particular YTM and bond value relation. Let's say face value is 1,000. Coupon is still 10%. Number of years is, let's say, 5. So I'm just listing down certain values of YTM, and I want you to calculate the bond values. Okay. So just quickly do the calculation. Okay. Let's say YTM ranges from 2%, 4%, 6%, 8%, 10%, 12, 14, 16, 18%, and 20%. I want the value of the bond at each of these YTM. Okay, so now of course we will do it as a collective task, right? So I'll just assign this task to all of you. So some of you may just take up, or I'll just do the assignment work. I can actually do this. 1 second. Yeah. Chitra, Saminathan, you will be doing like the first 4. Okay.
Okay, sir.
Vibhu and Sanjay will be doing the next 4 or next 3 maybe. Okay. And the others can work on the last 3. Okay. So just calculate these values, note it down, and then I'll take down the values from all of you. I hope we got it what we need to do it right now. Just do the calculation. Give me the values, guys. The value of the bond.
Sir, redemption value.
Take it as face value itself. Redemption value, take it as face value itself.
So for 10%,
Mhm.
it comes to 1,000.
This is 1,000.
And for 12%, it comes to 927.91.
927.91.
And for 14%, it comes to 862.68.
862.68.
Yes.
Okay. The first four numbers. First four numbers is
Sir, first four number for 2%, 1,267.08.
sorry, 1,000.08.
267.08.
Okay.
S-
Then
Yeah. So, sorry, sir. For 2%, 1,377.05.
1,377.05.
Yeah. For 4%, what I told you earlier is right.
1,200.08.
67.08.
Okay.
And 6%, 1,164.54.
1,164.54.
54.
Fair. 8%.
For 8%, 1,079.87.
1,079.87. Okay.
Sir, I used up to 4 decimals.
Okay, fine. That's fine. Okay, then 16%, 18%, and 20%.
16% comes to 803.54.
800.
803.54.
Okay. 18%.
At 18%, 749.82.
749.82. Okay.
Yes.
Then 20%. What about 20%? The number for 20%?
$700.94.
703.92.
703.92. Right? Is it 703.92? Okay, fine.
It comes for 20%, 700 exact.
20%, 700.
0.93.
Yes, 700.93.
That's 700.93. Okay, so these are the bond values that we get Now, one thing is prominently visible over here, and that is, that as the YTM increases, we find that the bond value is getting reduced. Okay. So definitely there's a, what we say, inverse relation. There's an inverse relation between the YTM and bond value. But I am not looking at typically, just the inverse relation between the YTM and the bond value. Rather, I want to go one step ahead and understand how would this particular thing really look like, when I plot it in a graph. Because when I plot it in a graph, the graph will actually tell me whether, there is inverse relation, but whether it's a straight line inverse relation or is it, having some sort of different shape. Okay. So that is something what we want to essentially know. Right. And based on that, we are going to do some other discussion also. So let me just plot this in a graph using Excel so that the things are pretty easier for us. So I'm just writing down the YTM numbers and the bond values. Okay. So YTM is essentially 2%, and every time I'm just increasing it by another 2%. So it took it up to what? 20%? Yeah. So I'll just get the bond value. In Excel, we can definitely use a PV function directly. So rate is 2%. Number of years was 5. Coupon was 100. Future value was 1000. So we came it as 1377. Yeah. So these are the true values of the bond with respect to YTM. And if I just try to plot this on a graph, so this is what we essentially get. So if you look at this graph, do you find it's a straight line?
No, sir.
It's a straight
No.
line. Or there's a little bit of curvature in it.
Curvature.
Yeah, little bit of curve is there.
There's a little bit of curvature, right? Now to make it more prominent, let me just do one thing. Instead of taking like, plus 2%, let me just add it with 4% every time. Can you see the prominent curvature now? If I'm looking for a greater range of values from 2 to 38%, let's say.
Yes.
There is a curvature. There is definitely an inverse relation, but the inverse relation is actually not a straight line inverse relation. Rather, it's a curvature that we observe. Right, guys?
Yes, sir.
Yeah. So it's a curvature that we are observing. Okay. So when we are looking at this particular aspect, not getting pasted. Okay. Anyways, so there is this curvature which is happening. So if I just plot a value and YTM on a graph, what we observe is with YTM being on x-axis and the value being on y-axis, it's not a straight line, but rather what we get is essentially a curvature. Right? So this is the curvature that we are getting. Right? Now, this curvature is actually going to have a lot of implication for us. Okay. So we'll discuss about this implication further. Right? But just to keep in mind that the relation between YTM and bond value, there is inverse, but it's not just a simple inverse, but rather there is a curvature happening. There's a curvilinear relation between the YTM and the bond value. Okay. So now this particular thing, inverse relation, is going to be extended further for our studies. Now, let us say we have information about, suppose, the face value of the bond is known to us. Suppose it is 1,000. Coupon is, let's say, 9%. Okay. Term or maturity is, let's say, 6 years. Redemption value is 1,100. And current market price of the bond is 960. Can we calculate the YTM? Can we calculate the YTM? Can we calculate the YTM, guys?
Yes, sir. By way of interpolation method, we can give the shock treatment for the OITM. Say some 10 percentage or 12%, 15% like that.
Okay.
We
and
can
have to do the interpolation, right?
interpolation.
Right. So let us say at YTM of 10%, you can get some bond value, right? So at a YTM of 10%, we can get the bond value as what? 90 into present value annuity factor at 10% for 6 years plus 1,100 into present value factor at 10% for 6 years. You can get the bond value over here, right? So just tell me what is the bond value at a YTM of 10%? Yeah. What's the bond value at 10%, guys? Give me the number. Well, based on that, we have to
1012.89.
1012
12.89.
12.89.
Yes, sir. 1012.93 is coming. I'm using four decimals, sir.
Okay, then at 11%, because we want to, reduce it to 960, right? So we'll say it's going to be
When we want to
90
reduce.
into present value annuity factor at 11% for 6 years plus 1,100 into present value factor at 11% for 6 years. Give me this number.
Nine 968.85.
968.85.
968.85.
Okay. Still we
Yes,
have
sir.
current.
Yes, sir. 968.81 is coming. It's okay. Rounding of difference.
Okay. At 12%, give me the answer. Because we have not yet reached this 960 level. What's the value at 12%?
948.5.
948.
Yes, sir.
No. Let's check this. At 12%.
927.31.
927.31. Yeah.
31.
Okay. So now we have to interpolate between what rate? Between 11% and 12%, right? Correct?
Yes, sir.
So at 11%, we had the value as 968.85. At 12%, we had the value as 927.31. And our current market price is 960. So we want to know what is that X percentage. We want to know what is that X percentage. Right? So for that, we'll say YTM and value. YTM 11%, it is 968.85. And at 12%, it is 927.31. So when we look at the change in YTM, for a 1% positive change, when you increase the YTM by 1%, the value actually reduced by how much? 968.85 minus 927.31.
41.54.
$968. $41.54, right? So we want to change this by how much, but it is 968.85 minus 960. So we actually wanted to change it by only 8.85. So what is the change that we want? What's the change that we want in the YTM?
.21.
So required
0.2130.
required change in YTM will be 8.85 into 1 divided by 41.54. How much is this?
2130.
2130. So the YTM value will be 11% plus 0.2130%, which is 11.2130%. That's the YTM. Okay. That's YTM, 11.2130%. Okay, guys. Okay, so that's how we compute the value of YTM when we have the information. Now, sometimes the bond values may be, given to us in a half-yearly manner also. I mean, the coupon rates may be given as a half-yearly. Then how do we go about really computing the value of it? Okay, so let's say par value of the bond is 100. Coupon is 7%, of course, per annum. But remember, this 7% per annum is payable half yearly. Maturity is, let's say, 5 years. Okay. And then the redemption is, let's say, 108. YTM that we have is 6% per annum. Now, how do we go about valuing this particular bond? How do we go about valuing this particular bond? Can I take the value of bond? I mean, if the coupon is 7% per annum payable half yearly, that is, of course, 70 per annum, but you're not going to get coupon as 70. You're going to get 35 per half year. So the value of bond is going to be 35 into present value annuity factor. So if your YTM is 6% per annum, if the YTM is 6% per annum, of course, it's going to be 3% per half year. So present value annuity factor,
ऊपर सिर्फ 7 रुपीज ही होगा ना कूपन
sorry, yeah,
100 रुपए per only
7 and 3.5, my bad. 3.5. So this is also 3.5 into present value annuity factor at 3% for what tenure, guys? If since it is 5 years, it's going to be 10 half years.
10 half year, right, sir?
10 half years plus also the redemption of 108 into present value factor at 3% for 10 half years. So whenever it is semi-annual coupon, we need to take that also into account while computing the value of the bond. Okay. Give me the value of this bond.
Sir, 110.22.
So that's 110.22.
I used 4 decimals, sir.
Okay. 4 decimals. 110.22 is. Okay. Okay. So remember, whenever it's a half yearly compounding, you need to adjust the coupon amount, the YTM, and also the tenure. Okay. Now let us take up few questions from the assignment part. Okay, let's go ahead with this question number 1. Nominal value or face value of a 10% bond. What is this 10% by the way, guys? What is
Coupon
it?
rate.
10%. Yes, there's a coupon rate. Issued by a company is 100. So nominal value is 100. The bonds are redeemable at 110. So bond is having a redemption value of 110 at the end of year 5. Determine the value of the bond if the required yield is 5%, 5.1, 10%, 10.1%. So you have to get the value of the bond at each of these percentages. Okay. So let's have a look at it. So this is question number 18, wherein we have the face value to be 100. Coupon is 10%. Redemption is 110. and the maturity is 5 years. Face value 100, coupon is 10%, redemption 110, maturity is 5 years, and what we have is we have to calculate the value of the bond at multiple YTM. So we'll just do it like this: year 1 to 5 and year 5. What are the cash flows that we have? Year 1 to 5 we have a cash flow of 10, and year 5 it is 110, right? Then we take present value factor at 5%, and then we take the PV. Present value factor at 5.1%, then we take the PV. Present value factor at 10%, and then you take the PV. And then finally, present value factor at 10.1% and the PV. So can we calculate these 4 values, guys? Can you obtain these 4 values? Get these values, guys?
For 5%, it comes to 43.29. Sorry, 129.48. 129.48.
Okay. This is 129.48.
Yes.
Yes, sir, we can say that. For
What
me, 129.49 is coming for me. It's rounding.
At 5.1%.
128.95.
128.95.
95.
Okay. Then at 10%.
106.21.
106.21. Okay. Then at 10.1%. 10.1%, guys.
Hundred 105.80.
105.80.
80.
105.80.
Yes.
Yeah. So 129.48, 128.95, and these are the numbers that we have. Okay. So when we changed from 5% to 5.1%. So percentage change in YTM was 0.1%, right? Can you just tell me what is the percentage change in the value of the bond? Like YTM, we changed by 0.1%, right? When we changed it from 5 to 5.1%, we changed the YTM by 0.1%. What is the change? What's the percentage change in the value of the bond? By what percentage did the value of the bond change? Can I say 128.95 minus 129.48 upon 129.48? So what's the percentage change in value?
0.41%.
0.41%.
Yes.
Okay. Then when we change from 10% to 10.1%, again the YTM changed by just 0.1%. But what will be the percentage change in the value? It is 105.80 minus 106.21 upon 106.21. What is this percentage change? What is this percentage change, guys? $105.80 minus 106.21. It is 0.41 divided by 106.21. What is this percentage change?
0.39.
0.39%. So we definitely observe that for a similar change in YTM, the bond value is not changing by similar percentage. Right? So when we change from 5 to 5.1, then it was 0.41% change in the bond value. When you change from 10 to 10.1, then the change is 0.39%. And mind you, it's not just that this percentage changes because of the decimal certainty. It is due to something else. Can anyone identify why is this percentage change in the bond value not equal at 5% and at 10%? Can anyone tell me? Can anyone identify the reason why the percentage change in bond value is not same for a similar percentage change in the YTM? Because when we change YTM from 5 to 5.1 or from 10 to 10.1, the percentage change in YTM was just 0.1%. But the change in the value is not equal at 0.41 or at 0.39.
Sir, maybe it's above coupon rate.
Sorry, maybe?
It's from the coupon rate, sir.
No.
5 to
Coupon is same,
5.1,
no?
it's less than coupon rate.
No, coupon is same for both. In all these four situations, you have taken
Yes, sir.
coupon at 10%.
No, sir. I want to just say that it's 10% below we have matured.
No, there's nothing to do with maturity or 10%. It is something that we have discussed in today's classes.
It's because of the maturity period.
No.
Sir, actually, we discussed in the curve we put no.
Yes.
There is no direct relationship between whenever there is an increase in the YTM, but it will decrease the bond value. But in case of when there is the opposite, inverse relation, but it's not the straight line. It is it's a what you said curl.
It's
What
a
is
curvature.
it? Curve nature. What is that? I don't know. Curve nature, right?
Yeah, you have this curvature. So let me just
curvature.
Let me just tell you how this curvature is essentially going to be, determining how the bond value is going to be changing. See, when we are at, I'm just, exaggerating the curvature a bit. In real life, it's not that exaggerated, but just to make you understand that aspect. When you change from 5 to 5.1, so let's say we had 5% over here and 5.1% over here. So when we just draw a line, so at 5%, this is the value. And at 5.1, this is the value. So can we see that the bond value is actually falling from here to here? Right? So bond value is basically falling from 129.48 or 129.95. Sorry. The bond value is falling from 129.48 to 128.95, right? And here the percentage change that we observe is 0.41%. Now, when we move a bit ahead, and now we have like 10% and 10.1%. Right? So we have 10% and 10.1%. So at 10%, we have this value, and at 10.1%, we have this value. So what we observe is at 10%, the bond value was this, and then at 10.1%, the bond value is this, right? Now here the difference that we see is 0.39%. Now, of course, we are seeing a very extreme cases of dispersion, but I'm just doing it for the sake of our understanding. So what we observe is that the fall in the bond value is at a faster pace from 5 to 5.1% as compared to 10 to 10.1%. Can we observe that, guys? Just look at the difference in the bond values. So at lower YTMs, when your YTM is really low, you will find that the bond value reduces at a very faster rate. The bond value falls at a faster rate. Whereas when the YTM has already reached a higher level, and there you have a reduction happening in the YTM, or when then there you see a YTM getting increased. What we observe is that the change is happening that is going to be comparatively lower, right? The change that we are having is comparatively lower over here, guys. Correct?
Yes, sir. Right, sir.
So it's because of the curvature, the percentage change in the bond value is not going to be constant. Because of the curvature, the percentage change in the bond value is not going to be constant. Okay, so just keep this in mind. We'll again revisit this concept in some time. Okay, let's go for the next question. Question number 19 is, an investor is considering the purchase of following bond. If he wants a yield of 13%, what is the maximum price he should be ready to pay? And suppose if the bond is selling at 97.6, then what should be his yield? I want you to try this question quickly, guys. Solve it. It's a simple question wherein you need to first get the value of the bond. And second case, they have given you the value of the bond and you have to give me the YTM. Extremely simple case, guys. Come on, do it.
95.28.
Bond value is 95.28 at 13%.
Yes, sir.
$98.28. That's perfect. So we can say at YTM of 13%, bond value is 95.28. Now, what's the bond value that the question has given us? The bond value is 97.60. So if I want to make it 97.60, I need to look for a lower YTM. So let's say at a YTM of 12%, give me the bond value. Because we want 97.60. So let's just do it one thing. Take it at 11%. At 11%, give me the bond value.
99.9.
99.98. Or you can say it's actually going to be 100 because face value is 100. So maturity value is 100. And if coupon is 11% and you're going to discount it at 11%, this bond value is definitely going to be 100. Right. So we want somewhere in between. At 11%, it's 95.28.
Sir, I discounted at 12%. It's coming in 97.59.
Okay, so you're getting directly the answer. Then at 11%, it is 100. So you want to know the percentage at which it is 90. What's the value given? 97.6. Okay, so we want the value at which it is 97.6. So just try to calculate this number with. What's the YTM over here? Get the YTM.
It comes to 1.02.
What's the YTM? It should be 12%. So if you
1.02 minus 13.
13
It will come
minus
to
1.02, that's approximately 12% itself.
Yes, right. In that way.
Perfect. Okay. Let's go for question 20 now. Calculate the market price of 10% Government of India security, currently quoted at 110, but yield is expected to go up by 1%. So 10% Government of India, currently it is quoted at 110. Yield is expected to go up by 1%. So when the yield is expected to go up by 1%, I need to first calculate what is the current yield. So here we have to compute the current yield. Okay, so current yield is simply going to be interest upon price. Current yield is going to be simply interest upon price. Okay, so interest is 10 upon 110. So which is 9.09%. This is the current yield. So what is the revised yield, by the way, guys? Because the yield is expected to go up by 1%, right? So I need to calculate the revised yield. So revised yield is going to be 9.09% plus 1%, which is
10.09.
10.09%, right?
Sir, how did you find that the 10% is interest?
It's given in the question, right? 10% Government of India security.
Okay, what is the face value?
Face value will be 100.
So how did we know that face value is 100?
Yeah, that's what my question is.
Because if it is currently quoted at 110, so
Which means including the interest,
sorry,
which means 110 is the including
no.
interest.
This is the current market price of the bond.
Okay.
Current market price of the bond is 110. So don't add that 110. Okay. So this is the market price. The coupon that is paid to you is 10%. Of course, if the bond is trading at 110, I can't be saying that the bond is having a face value of 1,000. Right? So ideally, the bond will be having a face value of 100 only.
Okay, which means that 110 is that traded now, which
Yes.
the value is includes of the interest.
It's the present value of interest and principal. 110.
That means
Okay.
we have to assume the face value is 100.
Yeah, face value is 100. Yes. Had it been the price, 1100, then I would have taken the face value to be 1,000.
Sir, if it is a traded on the premium or discount, how we will know?
If it is traded at premium or discount, if it is 110, and if I take the face value as 100, then it's obviously trading at a premium. So you generally take the face value in terms of what? 10, 100, 1,000. Bond, you don't have a face value of 100. Sorry, bond, you don't have a face value of 10. You will have a face value of either 100 or 1,000. And if the price is around 100, the face value is going to be 100.
Okay, you mean to say minimum denomination is 100 and multiply of 1,000.
It can be 1,000.
Okay. Right, sir. Thank you.
Okay. So 9.09 is your current yield. Now the revised yield works out to be 10.09%. Now at revised yield, if it is 10.09%, what will be the price? Price will be now interest, or this is what we call as the revised price. Revised price will be interest upon revised yield. So interest is 10 and the revised yield is 10.09%. So 10 divided by 10.09%.
99.11.
99.11. Okay, perfect. Then second case, a bond, you have to compute the market price. I want you to do this. Bond with a 7.5% coupon, 7.5% coupon, interest, face value is 100, term to maturity is 2 years, presently yielding 6%. and interest is payable half yearly. So how are we going to change this? The coupon is going to be 7.5% of 10,000, which is 750, but that 750 is for the full year. So half yearly coupon will be how much?
3.75.
3.75.
375, right?
375.
So this is your coupon. What will be the number of tenure that we are going to take?
4 years.
4 half years, basically.
4.5 years.
YTM will be also not 6%, but 3%.
3%.
YTM will be 3%. Okay. So just try to get the value of this bond, guys. Try to get the value of this bond.
Yes, it's coming 10,243.91.
How much? 10,000?
243.91.
243.91. Okay, so the second part of the question. You have like half year 1 to 4 and 4. Cash flows are 375 and 10,000. Then you have present value factor at 3%, and then we take the PV. So present value factor at 3%. How much is it?
3.7171.
3.7171, and fourth year PV factor
0.885.
0.885, and when you take the PV, it is 10,000.
243.91.
10,243.91. Okay, that's the question 20. Pretty easy. Okay, let's go for now question 21. Now we're landing on to questions wherein we'll have the convertible feature in them. Okay, so let's look at question 21. A convertible bond with a face value of 1,000 is issued at 1350. So convertible bond is issued at a price of 1350 with a coupon rate of 10.5%. Conversion rate is 14 shares per bond. So once the shares are obtained by converting from the bond, you'll be receiving 14 shares. Current market price of bond and the share is 1475 and 80 respectively. So each of the bond is trading at 1475 and each of the share is trading at a price of 80. What is the premium over the conversion value? So what is the premium over the conversion value? Okay. So convertible bond with a face value of 1,000 is issued at 1350 with a coupon rate of 10.5. Conversion rate is 14 shares per bond. Current market price is 1475 and 80 for the bond and the share. And what is the premium over conversion value? So first we need to get something called as a conversion value, right? So we need to get something called as a conversion value, and then we can definitely talk of a premium over that. Now, question 21. First up, market price of the share. What is the market price of the share? That's 80. Right? Market price of the share is 80. And conversion rate given. Conversion rate is 14 shares per bond. Conversion rate is 14 shares per bond. And then conversion value is going to be 80 into 14. Simple. Because if the current market price is 80 and you're going to get 14 shares per bond, then the conversion value is going to be 80 into 14. Okay. So 80 into 14 conversion value. This is going to be 1120. So today, if you're going to get it converted to shares, you're going to get the value as 1120. Then we talk of what is the market price of bond. Market price of the bond is 1475. So as compared to the conversion value of 1120, the bond is trading at a value which is significantly higher at 1475. So there is definitely a premium, right? So the premium over conversion value, premium over conversion value will be 1475 minus 1120. Premium over the conversion value, we say it's 1475 minus 1120, which is 355. Correct? Then if I ask you what is the percentage premium over the conversion value, the percentage premium over conversion value, we can say it is 355 upon conversion value is
1120.
Right? So what is this percentage? 355 upon
31.70.
sorry, 31.70. Yeah, 31.70 is the premium, or it's the percentage premium over the conversion value. Okay, that's question 21 for us. Easy. Now, after that, let's go for question 22 guys. 21, 20.
Sir, I have one query here.
Yeah.
That market value of the bond is 1475. That conversion value is 1120 per. How we are saying is a premium?
Because today, if you get the bond converted to shares, you will get shares worth 1120. Right?
Okay.
Because you're going to get 14 shares for each of the bond, right? So today, if you are
Yes.
given an option to convert, you can get shares which are worth 1120. Correct? But
Okay.
the bond value currently it is 1475. So of course, the bond is trading at a premium as compared to the conversion value. So premium as compared to the conversion value we are talking of. Okay, we are not talking of premium with regards to the face value or the market price something. No, we are talking of like today if I get it converted to equity shares, I will get shares worth 1120. But the price of the bond is 1475. Now, why is the price 1475, guys? Any idea why people are ready to pay a premium of 355 on this bond over the current market price? Like the current market price, all the shares, it is 1120. Current market price of all the shares is 1120. So what is this premium over the conversion value that we have, 355?
sir, yield which we get.
No, that's yield is not the reason. Because the reason is, if you're buying this bond, you will be entitled to 14 shares, irrespective of whatever is the price of the share. So we say that currently, okay, the price is like, 80. Okay, so currently, let's say the price is 80, but even if you buy the bond today at 1475, you will be getting 14 shares irrespective of the price being 80 or 90 or 800 or 900. So if this 80 becomes even 800, you will still be getting those 14 shares without payment of anything extra. So there is that upside potential. You can always get a value which is higher than the current value. And due to that potential higher value, the bond is trading at a premium.
Okay, sir. Which means we are losing 355 to get 1120 share when the market price of the bond value is 1475.
So you are ready to pay a premium of 355 for getting a bond which has got a current conversion value of 1120 with an expectation that if this 80 rises to, let's say, 100, or let's say this 80 becomes 200, so 200 into 14, you can get shares worth 2800 by paying 1475 today. So we don't know what is that upside potential, whether it will be 2800 or 3000 or 10,000. We don't know about that. But there is a possibility that the share price is going to increase. And for that expectation, people are paying, the market is asking for a premium of 355.
Okay, there is a implied assumption there is a price will get increased.
Yes, price will. Otherwise, if you are assuming that the price will fall, why would anyone pay a premium?
Yes, sir.
Right? If you're saying that the price is going to fall, or maybe for that reason, price is not going to fall, the price is going to remain constant at, let's say, 80. Why would I pay a premium of 355 then? Right? You always pay premium wherever you see something good happening in future, right?
Yes, sir.
Right? So it's that reason because of which you're ready to pay a premium of 355.
Right, sir. Thank you.
Okay, let's go for question 22 now. So Sarnam Limited has issued convertible debenture with a coupon rate of 12%. Coupon rate is 12%. Each debenture has an option to convert to 20 equity shares at any time until the date of maturity. Each debenture has an option to convert to 20 equity shares at any time until the date of maturity. Debentures will be redeemed at rupees 100 on maturity of 5 years. So debentures are going to be redeemed at rupees 100 on maturity of 5 years. An investor generally requires a rate of return of 8% per annum on a 5-year security. As an investor, when will you exercise conversion for given market prices of equity shares of 5, 4, 5, and 6? Cumulative PV factors and all is given. Okay, so let's first try to get the value of the share. Okay, so coupon rate is 12%. Each debenture is can be converted to 20. An investor generally requires 8% on a 5-year security. So let's first try to get the value of the debenture, right, if it is not converted. We are in question 22. If debentures were non-convertible, right? So if the debentures were non-convertible, right? So if the debentures were non-convertible, what will be the value of the debenture? Value will be 12 into present value annuity factor at 12 into present value annuity factor at 8% for 5 years plus 100 into present value factor 8% for 5th year. So what is the value of it? If the debentures were, let's say, non-convertible, what is the value of the debenture coming out to be? Give me the value of the debenture.
116.02.
Okay. 116.02. Now, if I give you a chance that you can get the shares converted and the market price is given to us as 4, 5, and 6. If the market price is given as 4, 5, and 6, so you can get it converted for 20 equity shares. What will be the conversion value? What will be the conversion value? So if the market price is 4, number of shares is 20, what will be the conversion value? Of course, 80. Second case, it is 100. Third case, it is 120. So if market price is 4, number of shares is 20, conversion value is 80. Second case, the conversion value is 100. Third case, the conversion value is 120. Now, if you're going to pay 116 for getting the share, and you have an option to get it converted to equity shares, when will you like to get it converted? When the market price is 4, 5, or 6?
6.
6, because you have paid 116 for getting the share. And when you've paid 116, you will definitely not get it converted when the price is 4 or 5, because you will be getting 80 and 100 worth of shares, right? So bond will be converted to equity shares. So bond will be converted to equity shares when market price of share is 6 and maybe above that. So anything above 6, you'll be getting profit over the conversion, and that's where you're going to get a higher value, and therefore the market price is going to be 6 and above is the price where the bond, it's something which we can convert it. Okay.
Yes, sir.
Yep. Easy. Let's go for the next question, which is question 23. Okay. So let's take this question 23, and after that we will probably take a break in between. So let's go for question 23 right now. The data given below relates to a convertible bond. Face value is 250. Coupon rate is 12%. Number of shares per bond is 20. Market price of share is 12. Straight value of bond is 235. Market price of convertible bond is 265. Okay, so face value is 250. Let's first take down the basic information. So we have face value as 250. Coupon rate is 12%. Conversion ratio is 20. So you have 20 shares per bond. Market price per share is 12. Straight value. What do you mean by the straight value of the bond? Straight value is 235. When we say straight value, it simply means we are talking of a value of a bond without conversion option. So it's the value of a bond without conversion option. Okay. So value of the bond without any conversion option, that is what we talk of as a straight value of the bond. So when we say straight value of the bond, it means if the bond wouldn't have got any conversion option, then it would have traded at 235. But then what's the market price of convertible bond?
265.
Market price of convertible bond is 265. Market price of convertible bond is 265. So you can see over a straight, simple, without any conversion option bond, this convertible bond is having a premium of 30. Now, why is there a premium of 30? Why is there a premium of 30? Obviously, people are ready to pay a premium for getting the advantage in the higher price, right?
Yes.
Right? Okay, fine. Now, what does the question ask for? Stock value of the bond. Stock value is basically conversion value of the bond. Okay. So the first part that we're getting is stock value or conversion value of bond. Stock value or conversion value of the bond. So 20 into 12. Stock value or conversion value of the bond is 20 into 12 is 240. So if you get it converted today, you can get it converted for 20 shares at a price of 12. So it's like, 240 is the conversion value. Then the second is percentage of downside risk, conversion premium, and the conversion parity price of the stock. Okay. So now when we have the stock value of the conversion value, it's 240. Now conversion value, value of the bond, if the conversion is lapsed, which means we are talking of what will be the value of bond if market price of share is 0. Suppose if the market price of share is 0, if market price of share is 0, if market price is 0. So what will be the value of the bond if market price is going to be 0? If the market price of the bond is 0, if the market price of the share is 0, will the bond value be also 0? If the market price of the share, let's say the share price goes to 0. If the share price becomes 0, will the bond value be also 0? No.
No.
Because if the value of the bond, if the market price is 0, can I say bond will not be converted? But can I say redeemed for cash? If the market price is 0, I will say, just do one thing. You don't give me any shares. You just give me the cash which is available. So when you say that it will not be converted, it becomes like a non-convertible. And that's where we can say the bond value will be 235. So it will become like a normal bond without any conversion option. So the bond value, if the market price is 0, that's going to be 235. Okay. Then what is the percentage downside risk? So current market price is 265. At the lowest, it can fall to 235. Because if the shares are something which cannot be converted, shares become worthless. I'm not going to get it converted, sir. Still, I can get the cash, and it means that the bond will be like a normal straight bond without any conversion option. So current value is 265. It can fall up to maximum 235 only. So therefore, from 265 it can fall up to 235. So downside risk is 11.32%. So we say that the downside risk is 11.32%. So percentage downside risk is 265 minus 235 upon 265, which is 11.32%. Percentage downside risk is 11.32%. Right? So maximum that you can lose in the bond value, that is 11.32%. Okay. Then the third part is talking of conversion premium, guys.
Sir, could you please explain that what is mean by downside risk here?
What is the current value of the bond?
230.
260.
265. Okay. Now this bond is obviously trading at a premium as compared to the straight value because of that conversion feature, right?
Yes, sir.
Right. So what if the underlying shares become worthless? Can I say now the bond will not be converted? Now the bond will become like a normal bond? Because if the shares are worthless, would any investor think of converting the bond to shares?
No, sir. If it's not what it's
No,
okay.
sir.
No. Then obviously in such situation, what is the value of the bond going to be? It will become like a normal straight bond, which is 235. Right? So today, if you realize that you're not going to get your bond converted to shares, you will say, okay, it's just like a normal bond. So when the realization happens that the bond is now just becoming a normal bond, then you can just say it is 265 minus 235 upon 265. I mean, the bond value may fall from 265 to 235. Right? So when that conversion thing is no more existing now, when you don't see the upside potential now, the bond value will fall from 265 to 235 because it becomes a normal bond, because it's no more convertible now. I mean, if it is convertible, but people will not get it converted to shares. So the bond value will fall to 235. And therefore, we can say that the bond value can fall maximum by 11.32%.
Okay. Up to 11.32 percentage,
You mean,
it is acceptable. Below that, it is not acceptable.
no, up to 11.32% is the loss that you can have.
Yeah, up to which we can minimum where we can lose, up to which we can convert the bond. Otherwise, we can keep
Otherwise, you'll
quiet.
go for redemption, cash redemption.
Okay, fine. Okay, sir.
Okay, so conversion premium now. Now for conversion premium, we say what is the current market price that, and we subtract the conversion value like we did in the previous question upon the current upon the conversion value. Okay, so now current market price of the bond is 265 minus what is the conversion value. So you can see each of the share is trading at 12 and there are 20 such shares getting converted. So it's going to be 265 minus 12 into 20 upon 12 into 20, which is 265 minus 240 upon 240. So what's the conversion premium here? 265 minus 240 upon 240. The today current conversion value of the bond to shares, if the bond are getting converted to shares, you will get shares worth 240. Right? You will get shares worth 240. And what's the current market price? That is 265. So 265 minus 240 upon 240.
10.42%.
10.42%. Yes. So compared to conversion value, the bond is trading at 10.42% premium. Then the fourth part is conversion parity price of share. Conversion parity price of share. Conversion parity price of share. It is like the bond value that we have right now upon current market price of share. Sorry, upon number of shares. Bond value upon number of shares. So bond value is 265 upon how many shares you're going to get? 20. So which is 13.25. So going by the current bond value, the shares are being bettered at a price of 13.25. right? So the question is anyway asking us the conversion parity price. So if you're going to get it converted, you're obviously buying the bond at 265 and buying this bond at 265, you'll get it converted to shares. How many shares you're going to get? You're going to get 20 shares. And if you're going to get 20 shares, 13.25 is the value that you're actually paying for each of the share. Okay. So that's this particular question 23 for us. Easy, guys.
Not easy. I need to revise.
Stock value or conversion value, it's just the converted value. I mean, value of all the shares that you will get today, right? Then the second part is, what is the downside risk? Downside risk is basically to what value the bond can fall, because we know bond is trading at a high value because there is that upside potential which the investors are seeing. Right? There's this upside potential which the investors are seeing. Now, if you just see that there is no upside potential, or I can say the shares are becoming worthless, then I will definitely say I don't want to get it converted to shares. I want cash. So if you want cash, then what will be the current market price of the bond? If it is going to be redeemed for cash, then it's 235. So what's the premium that you are paying, or what's the maximum loss that you can have? Is 11.32. And then conversion premium is similar to the previous question, which is like current conversion value is 240 and you're going to pay 265. So the difference between them, 25 upon 240, that's the conversion premium. Conversion parity price of the share is bond value upon number of shares. Right? So bond value is 265 upon number of shares is 20, which is going to be 13.25 as the conversion parity price of the share, wherein we say that today, if you're going to buy this bond and get it converted to shares, you're essentially paying 13.25 for each of the shares. Okay, so that's this convertible bond section. Now, we do have quite a good number of questions and certain good concepts to be coming our way. So before that, let's just take a break right now, guys. Okay, let's take a break. And, after that, we will continue with some other concepts in this bond market. Let's take a break, guys. let us go for the next concept now. We're going to discuss about something called as Macaulay duration and modified duration. Okay, Macaulay and modified duration. Let's try to discuss about that. Yeah, it's a new set of concept. It is going to be somewhat related to what we have seen as the curvature in the bond. So we are going to just calculate these numbers because actual interpretation and use of these concepts will be happening in the subsequent lectures. So we'll first see the concept of Macaulay duration and then followed by the modified duration. Okay, Macaulay duration and modified duration. Now, first let's talk of what is Macaulay duration. Okay, before I tell you what is this Macaulay duration, let me just demonstrate something for you. Let us say face value of the bond is 100. Coupon is 6% per annum. Okay. Redemption is 110. Maturity is 5 years. So face value is 100, coupon is 6% per annum, redemption is 110, and maturity is 5 years. Now, if I just list down the cash flows for all of these years, so cash flows is going to be like coupon 6% per annum, so 6, 6, 6, 6, and in the final year, you have the cash flow as 116. So let's apply the PV factor at the YTM. Let's say YTM is 5%. We can apply the PV factor and then get the PV and take the total of it. Now I will need over here the individual values. Okay, so PV factor at 5%. Can you tell me the PV factor at 5% for 3 decimals? 0 point how much? Give me the PV factors up to 3 decimals, guys.
952. 0.952.
0.952. Okay, second year.
0.907.
907.
907. Then
863. 0.864. 0.864.
864. Then
0.823.
0.823.
823. Then
0.784.
784.
78. Okay, that's the PV factor at 5%. Now let's talk of the present value. We can get the present value by multiplying the cash flow with the PV factor. So multiply the cash flow with the PV factor is
5.712. Year 1.
5.71.
712.
Then second year
5.442.
5.442.
2.
Okay. Then
5.184.
5.18. Okay. Then
4.938.
so that's 4.94. Then finally next one
90.944. 90.944.
okay 90.90. Just give me a total of all of these. Total of all the present values.
112.22.
12.22. 112.22.
Yes.
So addition of all of them, is it 112.22?
Yes, sir.
Yes. 112.22. Now, can I say this 112.22 is the value of the bond? Okay, so the amount that you are paying today, which is 112.22, to acquire this bond, you are going to pay 112.22 to acquire this bond. To buy this bond, we are going to pay 112.22. Correct, guys?
Correct.
Right? Okay, so now this particular value, 112.22, is this amount blocked? Is this particular value of bond blocked for how many years?
5 years. Yes.
5 years.
Is this full value of 112.22 blocked for 5 years?
Yes.
No, sir.
Then?
Each year we are getting 6 rupees, right?
No. I cannot compare 112.22 with 6. I need to compare present value with present value values, right?
Right. 5.31.
Can I say out of this 112.22, this 5.71 is actually blocked
Only for 1 year.
for 1 year. The second number is blocked for 2 years. Third number is blocked for 3 years. This one is blocked for
Sir,
and this one is blocked for 5 years. Correct?
Yes, sir.
What do we mean by block for 1 year, 2 year?
112.22 is what you're going to pay today, right?
Yes.
Against that, you're going to receive coupon and the redemption value. So I cannot compare 112.22 with 6 because 6 is, and these numbers are going to be received in future. So I'm just saying that the value 112.22 which I'm putting in today, the present value, the part of this value is going to be recovered in part in future years. It's not that today I pay 112.22 and the full value is going to be given back to me in 5th year. It's not that case, right? Because the value that I'm giving today, the amount which I'm investing today, this is not staying invested for entire 5 years, because out of this investment, every year we are receiving a portion of it. Correct?
Right.
Right? Every year we are receiving some portion of it. So out of 112.22, this 5.71 is blocked, or this 5.71 is received in 1 year. Then 5.44 is received in 2 years. Then 5.18 is received in 3 years. So in this way, the entire amount of 112.22 is not fully blocked for 5 years, but it is blocked at multiple intervals. This is blocked for multiple time periods.
Okay,
So
more than 5 years. It can be more than 5 years also.
Sorry?
It can be more than 5 years as well.
No, how it can be more than 5 years? In the 5th year, you will receive the final value.
Okay, maturity is 5 years, yes.
Maturity is 5 years. So out of this 112.22, you are receiving some portion before time also. Right?
Which means that it will be less than 5 years also.
So if I ask you, what is the time period that you need to recover the full value of the bond? That is, of course, 5 years, sir. To recover the full value that you have paid, you will need 5 years, definitely. But if I ask you, what is the average time period of your investment? Can I say that my average time period is 5 years? No.
No, sir. It will be less than 5 years.
Because 112.22 is not fully invested for 5 years. Out of this, 5.71 is invested for 1 year. 5.44 is invested for 2 years. 5.18 is invested for 3 years. So when we talk of Macaulay duration, it is weighted average of time period of investment. Weighted average of time period of investment. Okay, can you tell me what is the formula for weighted average?
Sir, here 5.71 divided by 112.22.
Normal formula for weighted average. Can you read summation of W into X?
Yes, sir.
W. Right? So when we want weighted average of X, it is summation of W into X upon summation W. So if I ask you, what is weighted average of time? Weighted average of time or T. Can it be summation of W into T upon summation W?
Yes, sir.
Summation of W into T upon summation W. Now, what? Okay, we say that T is nothing but this number of years. Okay, T or time period is nothing but this number of years. So what is this W then? What is this W?
Weight.
So weight on the, what thing are we going to assign the weightage as?
For how many years it blocked, sir?
The year which is blocked, it is T. What should be the weights? I need to assign weights, right?
Sir, weight we are going to assign for that PV, the value.
Perfect, yes. Because 1 year is having a weightage of 5.71. 2 years is having a weightage of 5.44. So in this way, this formula will be said to be summation of PV into T upon summation of PV. Okay, so this is going to be PV into T, present value into time period, and then you take a total of it. Present value into time period, and then you take a total of it. So present value, this is 5.71 into 1, which is 5.71. Then 5.44 into 2. What is the number?
10.88.
10.88.
10.88. Then 5.18 into 3.
15.5.
Yeah, 15.54.
Okay, then 4.94 into 4.
19.76.
19.76. Last value 90.90 into 5.
454.50.
450 point.
454.50.
Okay, 454.50. Okay, 454.50. Take the total of all of them.
506.39.
506.39.
39.
So, what should be the weighted average of T? Weighted average of T. It will be summation of PV into T upon summation PV. Summation of PV into T is 506.39 upon summation of PV is 112.22. How much is this?
4.5.
4 point
5.2.
506.39.
4.551.
4.551. So can I say the weighted average time period is 4.51 years. So we can say that my money is not entirely blocked for 5 years because I'm receiving something before, before that also. So the time period for which my investment has gone is 4.51 years. So weighted average of time period is 4.51 years, guys. Okay, weighted average of time period is 4.51 years, which is nothing but this 4.51 is what we call as the Macaulay duration. This is what we call it as a Macaulay duration. Right? So Macaulay duration is nothing but it's the weighted average of the time period of your investment. We can't be saying that our money is entirely blocked for 5 years for a simple reason because you are receiving something in between. Therefore, your weighted average time period or Macaulay duration is 4.5 years. Okay, what would be your answer if this same bond would have been a zero coupon bond, guys? If this same bond would have been a zero coupon bond, then what would be your answer? If this bond would have been zero coupon bond, then what would have been your answer?
In that case, coupon
Then-
rate would be zero and it would be zero, and the
So
redemption
all these
value on
coupons
the
are zero.
Yes,
No,
sir.
sir. On the fifth year, we will get that value, redemption value. We will get it.
redemption value. Yes.
So you'll receive all the value of redemption in the fifth year.
Yes, sir.
Since you're going to receive all the values in fifth year, can I say here the weightage for all 4 years is going to be zero? And you'll just
Yes.
have one value over here. So for a zero coupon bond, can I say Macaulay duration will be same as its tenure, which is 5 years?
Yes, sir.
Yes.
Are we correct, everyone?
Yes. Yes.
Yeah. So for a zero coupon bond, Macaulay duration and the maturity period is one and the same. Macaulay duration, maturity period is just one and the same. Because there are no coupons which are coming in between. Are we clear, everyone?
Yes, sir. Clear, sir.
Okay. So I'll just give you one question so that you're able to calculate this Macaulay duration once, and then we will pick up the another concept. Okay. So let me just give you certain facts over here. Face value is, let's say, 1,000. Coupon is 8% per annum. Term is 7 years. Redemption is 1050. YTM, yield to maturity, is 7%. Can you calculate the Macaulay duration here, guys?
Okay, sir.
So calculate the Macaulay duration for this.
5.70
5.70
years.
Macaulay duration. Just check if it's 5.70 years. Can anyone confirm? Is the Macaulay duration 5.70 years?
What is that? I'm getting, okay. 6.04 I'm getting.
6.04.
Yes, sir.
Okay. Well, let me just do this quickly for you using the magic tool that I have. We are having total 7 years.
So it's 5.70 years.
Cash flows are 80. 7th year cash flow will be 1130.
1130.
Right? And this 1 divided by 1 point. What's the YTM? 0.7.
7%.
Yeah. I used 3 decimal up to this time.
Okay. That won't have much of significance. Let's take a sum of this and then the sum of this, and then we have this divided by this. Sorry.
Present value into time. We have to calculate PV into T. This is present value, third column, fourth column. The PV into T, yes.
Yeah, 5.70. 5.70 is the Macaulay duration. Got it, everyone? Okay. Now there is something called as another duration called as modified duration. Modified duration. Modified duration is going to be calculated as Macaulay duration upon 1 plus YTM. So which is 4.51 divided by 1 plus YTM is 5%, right? So 1 plus YTM is basically divided by 1.05. So 4.51 divided by 1.05, which is 4.30. Okay, what does this modified duration of 4.30 mean? Modified duration of 4.30 mean? What does this modified duration of 4.30 mean? 4.30 modified duration simply means, modified duration of 4.30 simply means that for 1% change in YTM, there will be 4.3% change in the bond value. So this is similar to the concept of that of elasticity of demand. Do we remember elasticity of demand, guys?
Yes, sir.
Okay. The elasticity of demand. What was that elasticity for?
What is the mean of BV changing?
Bond value. So just like in elasticity of demand, we were changing the price and looking at what is the impact on the demand, quantity demanded. Same way over here, we are looking at what will be the impact on the bond value for 1% change in YTM. So when your modified duration is 4.30, when the modified duration stands as 4.30, it simply means that if you're changing your YTM by 1%, the bond value is going to change by 4.3%. Okay. So if you're changing your YTM by 1%, bond value is going to change by 4.3%. So which simply means that suppose YTM changes from 5%. YTM changes from 5% to 6%. If the YTM changes from 5% to 6%, okay. So if YTM is changing from 5% to 6%, then if YTM is changing from 5% to 6%, bond value will fall by 4.3%, which means the new bond value will be, what is the original bond value here? 112.12, 112.22. That will be into 1 minus 4.3%. How much is this number? 1 minus 4.3%, or I can say this is 112 point. I know this is not working here.
107.39.
107.39. 107.39. Yes. Which is where we're already aware that as the YTM increases, the bond value takes a fall or takes a hit. Right? As the YTM increases from 5% to 6%, the bond value is going to fall to 107.39. So this is what we mean by modified duration. More discussion about that and all things, we'll do it in the subsequent lectures. But right now, as we can understand, what do we mean by the modified duration? Modified duration is simply going to tell you that what will be the percentage change in the bond value for 1% change in the YTM. So when there is a 1% change in the YTM, what will be the change in the bond value that's going to happen? Okay, so for 1% change in YTM, there's going to be 4.3% change in the bond value, and the revised bond value will be this 107.39. Same way over here, can you tell me what will be the modified duration? Modified duration will be 5.7 divided by 1.07. How much is this? 5.7 divided by 1.07?
5.33.
5.33. Okay. So how do you interpret this 5.33? For 1% change in YTM, bond value will change by 5.33%. For 1% change in YTM, bond value will change by 5.33%. Okay.
Sir, how is that years considered as a percentage again? I mean, what is like
years,
the correlation?
Up to Macaulay duration, it is years. But once you divide it by the 1 plus YTM, then it becomes an elasticity measure. Right? This 5.77 is a change in the bond value with respect to YTM. It's like a first order derivative. Okay, more details about this. How is this derived at? How this functions? We'll discuss about that in the subsequent lectures. So right now, just have a brief understanding that this modified duration is nothing but it's a first order derivative, or it's a rate of change in the bond value with respect to the YTM. Okay. Now let's just take up certain MCQs for our calculation, for our discussion. Let me just share the MCQs with you. Yeah. Let's come to these questions. The first question. What will be the value for this? First question.
$950.27, 950.26.
Is it 950.26?
Yes.
First question answer. So you take like 1,000 is the face value, pays a coupon of 80. So 80 needs to be discounted every year for 3 years, and the final year value will be 100. It will be 1,000. So this should be. I mean, if I just apply the PV function.
Sir, 950 is coming.
950.
Yes, sir.
950.26.
Okay. Number of years is 3. EMT is 80. 3 is 1,000. Yeah, 950.26. The correct answer is 950.26, guys. Okay. What about the second one? Which of the following statements about Macaulay duration is true?
It decreases as the yield increases.
It is always greater than the bond's maturity? No. Macaulay duration
No,
is
sir.
lesser than the bond's maturity. It decreases as the yield increases? Well,
Yes.
we'll discuss
Yes.
about it later. Then, zero coupon bonds have a duration less than maturity? No.
No, it will be equal. It will be
Equal
equal.
to the maturity, yes. It cannot be used as an interest rate risk measurement. It cannot be used as an interest rate risk measurement. So we can say definitely it can be used as an interest rate risk measurement because Macaulay duration is further used for calculating modified duration. This is something which is to be contended. It decreases as the yield increases. Just think about how the Macaulay duration is computed. It is computed by dividing the present value into time period by the present value term. Right? Now, if you increase the yield, if you're increasing the yield, the present value will be lower. And if the present value is lower, the present value into time period will be also lower. And if that is the case, the whole number that you calculate for Macaulay duration is also going to be lower. And therefore, we can say it decreases as the yield increases, because as the yield increases, the present value keeps on reducing, and that leads to a further reduction in the Macaulay duration. Okay. Third one. What about third one, guys?
3.486.
3.486.
Yes. Maybe there is some.
Macaulay duration, 4-year bond with a 10% coupon and face value of 1,000. So if you just write down the time period 1, 2, 3, 4, and the cash flows are 10% coupon. So 100 will be the cash flow. 4th year it will be 1100. But remember, one important part over here is it is trading at par. So if you say that it is trading at par, what will be the YTM of this bond? If a bond which is maturing at face value is trading at par, what will be the YTM of the bond?
10%.
10% itself. Because since it is trading at par, it means people are not asking for discount, neither they are ready to pay a premium. So it means the coupon rate itself is your YTM. So we take the present value at 10% itself. So that's going to be this divided by 100 divided by 1.1 raised to number of years. And then we take, so these are the PV, then we do PV into T. So PV into time period. Which is 3486. So this will be 3486 divided by par value.
Yeah, 3.65 years for me. 3.48 coming for me.
3.49.
49, yes. 3.49.
3.4.
Yes.
But its fitting is a B only. It's near to B only, so we can choose B.
Yeah, 3.49 years, yes. Okay, then fourth question. If the interest rates are expected to rise, which of the bond feature is least desirable for an investor? If the interest rates are expected, it's a tricky question. If the interest rates are expected to rise, which of the following bond feature is the least desirable? Which one would you not be likely to have? See, the idea is
Short maturity.
Short maturity. Any other answer? Anyone else would like to attempt? No?
Because the bond value will decrease with the increasing interest rates.
Correct.
So short maturity.
No, not short maturity. It's going to be long Macaulay duration. Now, why is it so? Listen, when you say long Macaulay duration, can I say it implies larger modified duration? If your Macaulay duration is higher, even the modified duration is going to be higher. Right? Because
yes,
modified duration is obtained for Macaulay duration. And this means bond will be more sensitive to rate of interest changes. So if you have a longer duration bond, long Macaulay duration bond, the modified duration is going to be higher. And if the modified duration is higher, it's going to be more sensitive to rate of changes. So for example, if you have one of the modified duration is 5 and another modified duration is 10, this 5 implies 1% change in YTM will cause 5% change in bond value. But whereas for the second case, for the same 1% change in YTM, there will be 10% change in the bond value. So any bond which is having a longer Macaulay duration or longer modified duration, you will find that the bond is having 1% change in YTM is going to cause a higher change in the bond value. That's going to cause a higher change in the bond value. So that's your Macaulay duration, long Macaulay duration. That's a long Macaulay duration. Right? That's
Okay,
a long.
understood.
In this question, is the subject of is the element of subjectivity is there or not in this question?
Subjectivity.
To some extent, because it says if interest rate are expected to rise, which of the following bond feature is least desirable?
Least desirable, yes.
So, okay, if interest rate are rising, so high coupon rate, okay, short maturity, okay. No, there is no element. Okay, it's clear.
Yeah.
Hmm.
Okay, so it's a long Macaulay duration.
Yeah, no, it's long Macaulay duration.
Yeah, so it's a long Macaulay duration, which will be obviously.
Yeah, it is actually, you mean to say that generally if we simple write long duration, it means longer maturity period.
Yes.
Okay.
The longer
So
maturity, it means it's going to be more sensitive. So bond is likely to lose more of its value.
Yeah.
Okay.
Sir, which means we will get the present value on the higher weightage on the future value.
No, not like that. It's not like that. We have discussed, right, the modified duration concept. Like if modified duration is 5, there will be 5 times change in the bond value.
Yes, sir, we discussed.
In YTM. So if you have a larger modified duration, change in bond value is going to be substantially higher.
Jagbandhuji, can I supplement here something?
Yeah, please.
See, beta, basically, Macaulay duration can be defined as a time within which the investment in a bond is come back to you overall. Whatever you have invested the money in the form of interest and principal, it comes back to you. Now, where if interest rates are rising, so every investor asks that least desirable means he is more interested in short duration, short Macaulay duration. Long Macaulay duration means he will have to wait for long time, and he will not able to take the benefit of the rising in interest. Am I right, Jagbandhuji?
Yes, sir.
Okay.
Okay, sir. Thank you, sir.
Question 5, guys. The last one for the day. So bond with a Macaulay duration of 6 years has got a modified duration of 5.66. If the yield is increasing by 50 basis point, what is the approximate percentage change in price that is expected? So as we see, since there is a modified duration of 5.66, then we say change in YTM that's anticipated is 50 basis points. So 50 basis point means 0.5%. So what is the change in bond value that we may expect? It's going to be 5.66 multiplied by 0.5, which is negative 2.83%. So for 1% change in the YTM, there is 5.66% change in the bond value. So of course, if there's a 0.5% change in YTM, bond value is going to change by 2.83% in a negative side, because there's an inverse relation between the YTM and the bond value. Okay. Fine.
Right, sir.
So with that, we have done the MCQ section also. I think we are towards the end of our today's session. If any queries, we can address that, or else we can just call it a day.
Thank you, sir.
Okay.
Sir, in third question, is there is a short option to calculation?
In
third question, we have to calculation करनी पड़ेगी या कोई short method भी है इसका calculation?
यहाँ पे you can do short method quickly, because the numbers, 4 years won't be the answer. 3 and 3.17, if you can take a guesswork, but again, I would not recommend you to do the quick method, because for 3.49 would be approximately the answer, but then there are high chances, these numbers may be also correct. Otherwise, if the options would have been like 2 point something or 1 point something, then you would have safely gone for option B.
Yes, sir. Suppose if the option is given 4, 5, 6, something is 3.9, then obviously we can go for that.
You can go for it, because there is some change, approximation difference will always be there. Okay, don't worry about that.
Yes, sir.
And one thing more, the student asked regarding, is there any shortcut? Of course, there is one shortcut formula. but it is quite bit cumbersome to memorize it. So if you see there is only hardly 4 years are there. So on the calculator, you can quickly get this amount. So it will hardly take any time. See, in the MCQ question, if you see, I generally suggest a student in an MCQ type of a question, generally the time you need to present your answer. Okay, all working is in your rough working. So of course you have an ample time of with you in your examination to solve the same. Okay, student. So with this, we come to the end of this our session. And as you know that you can contact me at this phone number, or you can send us an email. And now this session topic will be continued in the bond valuation will be continued in the next class also.
Yes.
So revise whatever have been discussed in today's and come out with your queries, etc. So thank you, Jagbandhu sir, for sparing your precious time and enlightening the student on the topic of bond valuation. Especially, you have covered in a very good manner Macaulay duration, because Macaulay basically when we talk about volatility, so Macaulay duration is the main indicator of the volatility of a bond, and beta is basically in a volatility for the equity stock. So in the next class, we shall continue this topic. And student, thank you very much for patiently listening. So whatever you query, you can send us to us so that we can improve upon, we can work upon that. Okay, thank you very much. Okay, Jagbandhu sir, thank you.
Sir.
Thank you, sir.
Thank you.
Thank you. Bye-bye.
There is one more. There was one query from the student, Jagbandhuji. I think he has asked that. I have a new joiner of these classes, taking recorded session classes as well. Please let me know from where I can find assignment. I have downloaded study material Saransh, but unable to find assignment. Please help me. Student, please note that you can log in through your SSP portal. Okay. And then you can download the assignment. Once you have to log in, only then you can download the assignment. Okay. Thank you.